Hi, everyone. It's Joe with OPG, and it's 1 o'clock, right on the nose. We are getting ready to get started today and talk with Hedge Legal and Poseidon. We're still having people sign in. We have a large group today, so I'm going to give it about 2 minutes on hold. You won't hear any noise. And then we'll come back on and get started just so that not too many people miss out on the beginning. So hold on, hold tight for about 2 minutes. We'll come right back. Thanks. Okay, hi everybody again. It's Joe with OPG. We're going to kick it off. It's about 1:03, so we'll get started. We have about half of our attendees who registered currently logged in, so we'll get things rolling. Just a few basic house cleaning items for OPG members. Please take this opportunity to RSVP to a few other really important webinars we're doing and a couple of open surveys, so please take a moment to do that. For those, we opened this up to a larger group today because I think it's such a broad topic and a great topic. So if you're not an OPG member, feel free to email us, and I can talk to you about becoming a member of the peer group. You can email admin@ourpeergroup.com. I'll send it out to the group in the middle of the webinar for you via the chat function. If you have questions as we go along, there's a questions bar directly in the webinar panel. Please submit them through there, and we'll keep an eye on those, make sure that we can address them if we can, or certainly hold on to them so that they can be addressed after we're done. So I just want to introduce Poseidon Retsinas. Am I saying your last name right, Poseidon?
Yeah, Retsinas.
Retsinas, okay. Mine's Signorelli, so seldom does anybody get that right.
Yeah.
And Poseidon's the founder of Hedge Legal and has been nice enough to do a second session with us. We did one together, I think, in November, and
That's right.
for the OPG group, and had a really nice crowd and got a lot of positive feedback, and it was really valuable. So we've been working together to set up another one. So I really appreciate the time so we can talk about some ISDA stuff. So I'm going to throw it over to you, and you run with it.
Great. Thanks very much, Joe. And thanks everyone for attending. So Joe, thank you for organizing this. For those that do not know our peer group, It's a group that Joe founded. Joe has 25 years plus experience in the industry as a COO. He's one of the best in the industry, and he's founded our peer group to really help COOs and CFOs navigate and understand, the important issues that are going on, communicate with one another, and also, he provides a lot of very helpful insight and industry information to them. So that's what OPG does. So Joe, thank you very much for organizing this. I'm going to start on the topic now of the ISDA Master Agreement negotiation. This is a crash course. We're going to condense as much as we can into a very short period of time. ISDA is a fairly broad topic. So there's a lot of places we can go with this. The focus here is really on what's important for the buy side, what's important for hedge fund managers, and people sitting in that seat of a COO, CFO, or potentially even GC. So without further ado, this is a little bit about myself. I have 13 years of experience in the field, a lot of experience negotiating ISDAs. I worked on in private practice and on the buy side, and have a pretty good experience across working with many different hedge fund managers, different strategies, as well as negotiating with the different banks and the swap dealers on the street. The table of contents, what we're going to cover today, we'll start with the ISDA overview and architecture. Then we'll dig into the key terms and the operational issues. We'll look at the uncleared margin rules, UMR, and the impact that this is having. And finally, we'll talk a little bit about Hedge Legal and how we can help. The first thing that we need to ask ourselves and really make clear is, what is an ISDA, or what is the ISDA Master Agreement? Why is this used? When is this relevant? And what are derivatives? So an ISDA Master Agreement is an industry template document that was created to facilitate and enhance the ability of market participants to trade in OTC derivatives. OTC derivatives, not to be confused with listed derivatives. So under the category of a derivative, you would have two main categories. A listed derivative, which would be like a futures traded, which is cleared on an exchange. And you would have OTC derivatives, which are bilateral. They're between two parties, and those are not, they're not listed in any way. Those are subject to the ISDA. Within that subcategory of OTC derivatives, there is a category of cleared OTC derivatives, which are not covered under an ISDA. Those are typically, those are done under a framework similar to the futures clearing, so a futures clearing agreement plus an addendum. So those are the three main categories. What we're looking at here is really uncleared OTC derivatives. And a derivative is essentially a contract or an agreement between two parties, which is based on where that contract's value is derived based on some other underlying asset or thing. So for instance, you use a derivative when you want to get exposure to a certain asset or an index, which you either don't want to buy physically or you can't access it physically. An example, typical example is an equity derivative. So you can go out and buy Apple stock, or you can enter into a derivative which references the value of that Apple stock, and have that governed by an ISDA. So equity swaps are very typically used by the buy side. We also have currency FX forwards, which are also very heavily used in this space. Now, why do we need the ISDA? What do we do if we didn't have the ISDA? That's the question. If you did not have an ISDA and you wanted to trade these types of derivatives, that was the case pre-1980 or 1992 when the first ISDA Master Agreement came out. Before that date, in order to do one of these transactions, you needed to enter into a contract documenting the terms and conditions of that arrangement. Now, as you can imagine, if you're entering to a lot of these transactions, which parties typically are, you would need a separate contract for each of these specific arrangements. So the paperwork was very heavy. Add to that because this is or really was, and now it's becoming more regulated, but it started off being quite unregulated. There were no standards. There were no ways to be able to compare, if you've done an equity swap at one bank versus an equity or an interest rate swap at another bank. There were no commonalities amongst those terms. So the market was very inefficient. It was very difficult for participants to enter into these trades and to effectively deal with them. The ISDA Master Agreement was developed, and ISDA stands for the International Swaps and Derivatives Association. That came out of in the 80s. This organization came together to standardize and put together a common framework that could be used by participants across the globe to transact in these derivatives. And so the ISDA Master Agreement was created. The first major ISDA Master Agreement was the 1992 version. It helped proliferate and helped the market trade these contracts much more efficiently. And so that's really why we need it. It's to make the transaction process a lot more efficient, and also to give parties comfort around the enforceability. So here I have a note about legal opinions. There are legal opinions in the different jurisdictions that come to support the enforceability of certain provisions of the ISDA, of its netting and of the collateral, which we'll talk a little bit about the features of the ISDA. The second thing we should ask ourselves is why does the buy side need to negotiate the document? If this is the master agreement is based on an industry standard form, one would think that there's really nothing to negotiate. The terms are already there. It's true that the document is based on an industry standard form, but the banks skew the documentation in their favor, and in some cases quite heavily in their favor, meaning the document, the ISDA master agreement, starts out on a level playing field. But the first draft that any hedge fund will receive from their bank, from the swap dealer, is going to be changed and skewed in their favor with additional termination events, giving the bank different ways out of the arrangement, as well as certain covenants and obligations on the fund. So what's really important in all of this is that understanding what's in the document and being able to limit it in the negotiation to what is market practice and what the banks will actually really need. Because if you go in an unnegotiated form, there will be many ways out for the bank. There will be many ways that your relationship can get killed. From the buy side perspective, I think the most important thing you want coming into this relationship is stability. You want stability with your trading counterparty. You want to know that the terms that the trades you're entering into will go to term, and that the calculations and the payments related to them will be made. From the bank's perspective, they're looking to make money off the business, but they're also looking to really protect themselves from a counterparty risk and credit perspective. Hence why they stack the agreement in their favor, so when there are signs of trouble, they can pull the plug. If the plug gets pulled, that's going to be costly. For one, there will be a loss of exposure, which can be quite devastating depending on the situation of the market. Being closed out in a bad market can be really harmful to a longer term strategy. But also the termination itself and the way that the calculation of those payments at the termination will also be unfavorable if the fund is found to be in default or subject to a termination event. Some other considerations here is that the documentation is quite complex, even though it's based on an industry standard, and it's very heavily negotiated. So there are multiple layers of it. So coming into a negotiation, not understanding the complexities and what market practice is, it'll be challenging to be able to negotiate effectively. Final point I wanted to make on this slide is, yeah, go ahead, Joe.
Besides, I just had a question come through. I just thought I'd throw it out while you're on the slide. Could you just, for a few seconds, cover, what some of these closeout shutdown things are, and sort of what your recommended first thing to do is, assuming that you fall into that category of, I guess you would call it a termination event?
Yes, I'm gonna go into the termination events at length, and discuss what the most important changes are. So if that's okay, I'll just wait to get to that because it's coming up.
No problem.
Okay, great. One other thing to just consider here is cross default. Bad terms in an ISDA can create defaults, or it can be imported as cross defaults into other agreements. So it's important where a fund has multiple agreements with the same bank, or even agreements with other counterparties, it's important to be mindful of terms, because bad terms in one agreement and being put into default under one agreement can trigger defaults in other agreements and create a cascading effect. How do the legal documents work? We've touched on this already. It's an agreement, the ISDA master agreement. It's an agreement between the fund and the bank. It's based on a standard master agreement, and there's negotiation that takes place in the schedule to the ISDA, as well as paragraph 11 and cert 13 of the credit support annex. This is the overall framework and architecture of the ISDA. There's the ISDA master agreement, either a 1992 or a 2002 version. Most often these days, the 2002 version is used. There are a couple of differences between the two. For instance, how termination closeout is determined. And it is thought that for the most part, the 1992 version is a little bit more beneficial to the buy side, since it has some longer built-in grace periods. The negotiation to that master agreement occurs in the schedule. Then we tack on the credit support annex, which is the document that governs the transfer of collateral. So what we're talking about here is there's collateral that's put up in support of the obligations, both an initial margin or an independent amount at the start of the trade, and a variation margin, which is a margin computed on a daily basis based on the mark-to-market, or basically the market movement, how the swap is changing in value on a daily basis based on the underlying asset which it's referencing. So settlements and payments typically don't occur on a daily basis. They may occur monthly. So without any collateral in support of the obligations, there can be significant exposures built up over the course of that month, or whatever the settlement terms are of the particular swap. Every trade, called a transaction, is documented by a confirmation. So once you enter into a trade, there will be a confirmation issued that needs to get signed. There's a workaround to that, which is a master confirmation agreement. A lot of the terms that would be normally baked into a confirmation are put into the master confirm, and this allows for a quicker, the issuance of what's called a transaction supplement. So a smaller document that just really details the economic terms specific to that trade, and usually that does not need to be signed. So this master confirmation can make the trading process a lot more efficient and reduce the paperwork that's needed. Over here we have a bunch, there are ISDA definitions. ISDA has published a number of definitions which tie into this framework and cover specifics related to certain markets or certain types of instruments that are traded. Again, all of this creates a common language so that parties transacting in these agreements are able to do so efficiently and quickly. This concept, this is a concept we touched on earlier, and at a fundamental basis, this is the most important thing underpinning the ISDA master agreement and what it is, and it's the concept that you can have multiple transactions, multiple trades, which without the ISDA master would be documented separately. These multiple transactions that form part of the same agreement, they can be netted for payment purposes. They can be netted for all the margin calls and exposures, and also at termination, they are netted and terminated together, and there's one single amount paid. So from a credit perspective, it allows to have the entire relationship governed under one framework. I'm going to touch on this quickly. An umbrella ISDA, you may hear about this or you may use it for managers that have multiple funds dealing with the same banks. So for instance, Fund 1, Fund 2 with the same bank. Instead of having a separate ISDA documented or separate paperwork, you can have and I'm putting umbrella in quotation marks because that's not, you can have an umbrella ISDA, one document that would actually create separate agreements between the fund and the bank. Usually the different funds would be listed in the annex. So this is a helpful tool, particularly when you have multiple funds, and then when amendments or changes need to be made to documentation, you can amend one document instead of amending multiple ISDAs. One point on that is that the recourse between the funds needs to be distinct. So the ISDA 1, which is between Fund 1 and bank, recourse by bank should only be against Fund 1. It should not go to any of the other funds. We touch more on limited recourse later, but this is one very clear application. Now, Joe, coming to your question on the key terms. So now we're gonna dig into the key terms and the key negotiation points. Events of default, termination events, and additional termination events, operational matters, and then there are other provisions that come up which are helpful to know about. Before we talk about the specific events of default and termination events, I think it's important to clarify, why do we have these two concepts? What's the difference between an event of default and a termination event? I guess the distinction is rather simple. Event of default usually means something has gone wrong at a certain party, and the consequences of that are a little bit more severe. And a termination event is a category of event where neither party is at fault, but it's not possible or not practicable to continue the relationship anymore. So there needs to be a termination. There are different consequences. Events of default result in an early termination of all transactions. Termination events only result in the termination of transactions which are affected by that termination event. How the closeout amount is determined is also different. So basically, who determines what the payment is at the end of the day can differ depending on an event of default or termination event. And importantly, there is a condition precedent that a party only needs to continue making payments to the other party if that other party is not in default or a potential event of default. That doesn't apply to termination events. So if your counterparty is subject to a termination event, you would still continue to need to make payments to them. So the event of default, if there's an event of default or a potential event of default active against you as a fund manager, your counterparty can withhold making payments to you. So that can be pretty significant. There's also an obligation to notify termination events, but not EODs. Now, what are the events of default? The events of default are baked into the standard ISDA master agreement. They are negotiated on a number of points, but what's good about the master agreement is that the framework of these events of default is there, and managers should be mindful to try and keep the events of default as close to the ISDA standard as possible. Areas where banks will usually insist on changes, for instance, is under the default under specified transaction. They'll look to expand the types of transactions which would create this default. So a specified transaction at its essence is a trade between the fund and the bank, which is not governed under this ISDA. And it could also affect any specified entities of the bank. So usually they'll bring in affiliates as well. They'll also look to expand this to be a specified transaction to go beyond just what a derivative is and to bring in other types of payments or margin obligations, particularly when you have an ISDA and a prime brokerage agreement with the same counterparty. They will look to make to expand specified transaction to include a margin loan, so that a default under the PB gets pulled into this directly. Another area is the cross default. Cross default pertains to defaults that one party to the agreement might have under other agreements outside of the ISDA. So if the fund has an ISDA with Bank A and also has an ISDA with Bank B, a default under the Bank B ISDA can be imported through this cross default provision into the ISDA master agreement. Now, the standard terms of cross default is related to something called specified indebtedness. And specified indebtedness doesn't typically include derivatives, although banks will seek to expand that. So there's a number of changes here that the banks make to expand the application of these, which the buy side should push back on. And in particular on cross default, something that the buy side should look to negotiate in is making cross default a cross acceleration provision. The difference between a cross default and a cross acceleration is, as in that example I gave earlier, a default under another agreement can become a default under the ISDA. However, if this becomes cross acceleration, it needs to be more than just a default under the other agreement. It needs to be a default which the other party is acting on and terminating that other agreement. So it's a much more severe event. So moving this to a cross-acceleration standard is helpful and will minimize situations where this could be used against a buy-side firm. Next, on the termination events, there's a little bit less to say on these. The illegality, force majeure, tax events, and credit event, those are standard events baked into the ISDA. They are sometimes altered, but this is not where most of the negotiation takes place. Where the negotiation really centers is around what's known as the additional termination events. Additional termination events are really a hybrid between an event of default and a termination event. Remember, we said event of default means something has gone wrong at a party, and it's a serious event, for instance, a failure to pay. And a termination event, as we saw here, is something that's usually external to the party. So a change in law could create an illegality. There could be a force majeure event. There could be tax events that occur based on changes in tax law, which make the transaction, change the economics of the transaction significantly. The additional termination events are really things that in some ways have gone wrong at the fund, or are warning signs of things that may go bad at a fund. So the counterparties, the banks, will put these in and will really try and stack the deck here to give themselves more outs where these events have occurred against the fund. The most common one is the NAV triggers, the NAV decline triggers, which we're going to discuss in much more detail in the next few slides. But essentially, that a NAV trigger is where the fund's NAV has been adversely impacted. That should give rise to the right for the bank to terminate the ISDA. Sorry, just before I go a little bit forward here, I wanted to mention that the rationale and the reason why the banks stack the deck in their favor, a big part of it is the credit risk and the fact that the risk of a bank defaulting is less than the risk of a fund defaulting, given their credit profile. And so that's really the argument that's used to underpin all of these events that are here. The fund is in the business of trading. It may be taking on more risk, and the risk of a blowout of a fund is much more significant. So the bank needs to have these early warning signs available to it in order to be able to terminate and get out of the trades. Now, coming to the events, change in key persons. Usually the key person is the founder or an important decision maker at the fund or at the manager level. It's important here to make sure that the right individuals are identified. And what you want to do is you want to add in more than one person and make it such that both of those people, or 2 out of 3 of people, need to cease to act. If you have one key person and that key person ceases to act, that may give rise to an AT. But if you have 2 key people and you say both of these 2 people need to cease to act, then there's less likelihood of that happening. In addition, you should add in that if the key person ceases to act, there needs to be an opportunity to replace that person with somebody else who's reasonably acceptable. Failure to deliver reports. The banks will require that the fund deliver its monthly NAV statement, financial statements, and potentially other information. Any failure to deliver these reports is typically put up as an ATE, an additional termination event. What's important is that there be a grace period associated to this. If there's been a failure to deliver a report, there should be at least a 2 business day grace period after the counterparty has notified the fund of such a failure and able to remedy it. A lot of times these reports are sent out by fund admins or other operational staff. It could be missed and it's not that significant. Changes and breaches of investment guidelines. This one, I would say you should try and strike it completely, take it out. If it needs to stay in there, it should be limited to breaches which are really material and breaches that have a material adverse effect on the fund's ability to perform its obligations under the agreement. So it's important to qualify this. I'll say it's important to qualify a lot of these ATs with these types of things, such as such failures creating material adverse effect on the fund's ability to perform. The same thing would apply here with these reputational risks, regulatory actions. What we're talking about here is events additional termination events that relate to a key person or an employee or trading personnel of the manager becoming subject to some litigation or being subject to some regulatory action. Important here to try and limit the individuals that would actually be in scope, that to specify that any of the type of regulatory action or litigation should really relate to the person's capacities and the functions related to the investment activities, and also to leave some carve-outs for any of those litigations or actions, regulatory investigations against them being dismissed within a period of time, for instance, 30 days. Here there's an obligation. So there is an obligation to notify your counterparty of your ATEs. And as we'll see later, we're going to look, and it's called the Fisher cut bait provision or a deemed waiver. We're going to want to notify our counterparties of these additional termination events so that we can limit the time in which they have to act on them. So more on that later. One ATE that funds should add against the banks is the credit downgrade event. So this would be an ATE that would get triggered if a bank, the swap dealer, falls below investment grade. And this is justified if a bank is in trouble and falling below investment grade, it should give rise to the right for the fund to be able to terminate the transactions and do so in a way that's favorable to them. Okay, next slide. The NAV triggers. These are very heavily negotiated. There are 4 key points in this: the amount, the percentage of the decline, the time period over which that decline is being calculated. Typically, we see monthly, quarterly, and annual, as well as a NAV floor. The starting and stopping point of each of those calculation periods. For instance, is it a rolling calculation period? Does it go from any day to any other day? Or does it go from month end to month end or period end to period end? You really want to have this going from a period end to from the start of a period to an end of a period, so that you don't need to monitor this on a daily basis and look back to multiple periods. Remember, there's an obligation to notify of the ATE, and so it can become operationally cumbersome, if not impossible, to be monitoring this on a daily basis and notifying it if it were to occur. The last item is the factors used to calculate the fund's NAV, meaning, is this a total NAV or are we looking at a performance-based NAV? This table shows all of the considerations and really, I think, is a good guide as to how you should be looking at all of your NAV triggers. So on the left here, we have the periods: the monthly period, a quarterly, annual, and the NAV floor. This is a range, a percentage range of decline thresholds that we'll typically see. The 10, 20, 30, this is really on the lower end. And I've seen this in cases where you have much smaller managers or very risky strategies. But I would say the minimum thresholds that the buy side should be able to achieve are as follows: a 15%, 25, 35, and 50 on the floor. And importantly, the monthly and quarterly triggers should be based on a NAV per share, or a NAV that excludes subscriptions, redemptions, and withdrawals. These are not offered up in the standard terms. Usually the template that's provided by the prime broker, by the counterparties, excuse me, will provide for pretty low triggers for determinations, calculation periods to be going from any day to any day, and for all of these to be based on a total NAV and not NAV per share. So these are minimums that I think most funds should be able to achieve. Okay, carrying on with other operational matters. These are other matters that come up in the document that are details, and they're important to be looked at. Methods of notification. How are things being notified to one another? Making sure that it's going to people that are going to be able to act on things, both for legal notices as well as operational margin calls. Collateral timing. What is the timing for the posting of collateral and those cutoff times? Importantly, what are the types of eligible collateral? What types of currencies is the fund able to post and receive? Is the fund able to post securities? If so, what are the haircuts that are applicable to those securities? Importantly, how is the collateral requirement determined, and how can collateral and margin calls be disputed? Particularly around the independent amount or the initial margin. We want to make sure that the independent amounts and how those initial margin amounts are determined, because the fund will be on call to provide those to the banks. We want to make sure that those independent amounts are clear, that they can't easily be changed, or if they are changed, it's based on a very particular specific formula that the manager is aware of, so that you're not caught off guard with changes in margin requirements. Lastly here, the delivery of the NAV statements, making sure that you can deliver all of the financial information they're looking for and in the time periods they want it. NAV statements will typically be, after month end. A lot of times you may see banks looking to get this NAV statement within 10 days after the end of a month. For some managers, that's not possible. Then the final NAV is only available at 20 or 25 days after the end of a month. So it's important to be able to deliver those in a timely way. And also to have email addresses of, and ideally documented in the ISDA, of where you can send this information to. Some of the other provisions that come up: amendments and assignment. Sometimes banks will throw in that they can amend or assign the agreement to their affiliates without consent. Those should be taken out. There are some tax concerns. Is there any possibility for treaty application? Can you get a reduced rate of withholding? So you want to try and cover those off if there's any benefits to be had there. ISDA protocols and market counterparty manager. Anyone who's done an ISDA before is familiar with these, and basically what they are. The ISDA protocols are industry-wide amendments that can be adopted into documentation. So when there's a change in law or change in market practice, instead of every party needing to bilaterally amend all of their ISDAs, ISDA will issue a protocol which allows for the market at wide to adopt those changes. This is the case for the Dodd-Frank protocols, and also coming up for the IBOR, the benchmark reforms. Market counterparty manager, also known as, or one part of that is ISDA amend, ties into the protocols. And again here, every manager onboarding a fund will need to populate information into market counterparty manager with respect to Dodd-Frank 1 and 2 when dealing with a US swap dealer. And so these are things to be aware of. These are things that can take time in the course of an onboarding, and there are details that should be addressed properly. Some other things that come up: we have side letters, side letter from the investment manager. Some banks will insist that the investment manager provide representations as to its capacity, its authority, and also provide certain indemnities. So it's really important to be mindful and careful about what you're representing in these investment manager side letters, so that you're not taking on more liability at the investment manager level than you should be. Finally, some of the key terms that the buy side must add into the agreement. So these are things that you will not get, they will not be appearing in the document. You need to add them in. First one is the Fisher cut bait provision, or let's call it a deemed waiver. What this does is it forces the non-defaulting party to act within a certain period of time or lose its right to terminate. Example, if you've hit a NAV decline trigger, in the absence of any Fisher cut bait wording, once that NAV trigger is hit, it remains into the future. So a counterparty could come back months or a year or 2 years down the road and use a NAV trigger that would have occurred in the past against a fund. It sounds bad, but it is possible. And so with the Fisher cut bait provision, we want to bring in all of the events of default and all of the termination events, additional termination events into this to say that if any of these events, if we fail to pay you, or if we've had a NAV decline trigger and we've notified you of such fact, you have 30, 60, or 90 days to act on it. Getting 30 days is best, but usually, if you end up with a 60 or 90 days, it's not as bad. It's better to have this at any day or any level than not having it, because in the absence of it, you need to go out and seek waivers from your counterparties to waive those events. Otherwise, you're at risk that they could use them against you in the future. The calculation agent. The calculation agent makes a lot of determinations for amounts to be paid under the documentation. So it's important that because we're dealing in an OTC derivative market space, and some transactions are easier to mark than others, it's important to be able to, for one, here dispute any calculations that have been made by the calculation agent in the normal course of business. So you want to have a dispute process baked into the agreement, which allows you to challenge the calculations that they've made, and if you're not able to agree with them, to appoint a substitute independent third party to make those calculations. And also, if because the calculation agent will be the bank, it will typically be the counterparty, the swap dealer. And you also want to have express language in there that if the swap dealer is in default, that the fund can act as the calculation agent. Finally, limitation of liability. In an ISDA and in every other trading agreement that your fund has, you must include limitation of liability wording. This is to limit recourse by the bank against other funds that you might manage, against the manager itself, and against any investors. So it's important, it's a belts and suspenders, but it's important to have it there to protect yourself and to protect your investors. And a number of investors will look for this type of thing in their due diligence. Okay, so we've covered off the key terms. I'm looking at the time, 1:42. I'm gonna very quickly touch on the uncleared margin rules because they have a profound impact on the ISDA architecture as it relates to the posting of collateral. The uncleared margin rules are pretty much they're a pretty big game changer when it comes to initial margin. Initial margin for the buy side has typically been required to be posted. So the buy side must post initial margin to their swap dealers. Conversely, the buy side is not receiving initial margin from their swap dealers. The uncleared margin rules change that. For participants that are in scope, because not everyone is in scope, and we'll look at that in the next couple of slides, but for anyone who is, for counterparties that are in scope and relationships that are in scope, it requires that initial margin be exchanged between both parties, and also that it be held in a segregated third-party custody account. Again, this third-party segregated initial margin or segregated custody collateral is not required, is not done in the normal course of business with credits, with ISDAs and credit support annexes. Collateral is usually just exchanged directly between the parties. So the adding in of this custodian adds a significant layer of complexity and operational complexity. Now the implementation, in green here we see what's already been implemented. Things have been implemented in phases depending on the aggregate notional amounts that funds or entities have in notional derivatives exposure. Phases 1 to 4 captured the largest market participants. That's already implemented. Phases 5 and 6 are coming next. Phase 5 was supposed to come into force September 1st, 2020. So it was supposed to be this year, but it recently got pushed back, largely due to COVID. And this impacts firms that have an aggregate average notional amount above 50 billion of uncleared OTC exposure. Phases 6 is for 8 billion. So phase 5 will not capture that many buy-side participants. It's expected that phase 6 will capture a much larger portion of buy-side participants. We covered this. This is what this is another view of the documentation architecture pre-UMR. So let's say if you're not impacted by UMR, this is what you'll have. You'll have your ISDA master, your schedule, your credit support annex. The swap dealer will be, the bank will be party A. They'll post variation margin through to the fund. The fund will post independent amount or initial margin plus variation margin over to the swap dealer. Now get ready for this. When we move to UMR, when we move into the next slide, the post-UMR architecture, there's a number of other elements added. This part here remains the same, but there's a new workflow added here for an initial margin CSA, and this is for the regulatory initial margin requirement. So not only do you need to exchange initial margin, but it needs to be done in accordance with regulatory requirements in terms of calculating what that amount is. You need to appoint a custodian. There needs to be a custodian. Oh, on this side, you should also see another custodian here that's dropped off. But the hedge fund has a custodian, and the swap dealer will also have a custodian. There will be an account control agreement between two sets of account control agreements here and here, which are tri-party between the fund, the swap dealer, and this custodian, which governs the transfer and when that collateral can be released. So suffice it to say, if you think you're impacted by this, you should be looking into it now. There are significant impacts. This will significantly impact the operational workflow. How we can help. So Hedge Legal, we focus in on the negotiation, so we can help negotiate new agreements. We can help benchmark existing agreements that managers have and basically mine the data points so that managers with a lot of agreements know what's in their documentation. And we also help with UMR implementation. On the next few slides, there's a little bit more information about our firm and our team. Here is the core of our team. And on this slide, we also have a number of consultants, which are industry experts in certain areas, which we can work with for larger launches and ramp up when larger projects are needed. So Joe, that brings us to the end of the presentation. We still have a reasonable amount of time for questions. So why don't I turn it back to you? Let me know if you think there are if there are any questions, or if the audience wants to ask any questions about anything we've discussed. I'm happy to dig in deeper on some of the issues we've covered or ones we haven't.
Yeah, that's great. No, I was writing my own questions out as you went that I wanted to cover, and you systematically answered almost all of them. So it's very thorough. It was terrific, and sort of easy to understand in a very complicated area. So I appreciate that. What on the UMRs? Are you finding that the brokers are, proactively reaching out to funds with adjustments to their wording and setting up these tri-party agreements actively, or do you think that the funds have to be taking the more active role in reaching out and saying, hey, we need to do this? I find, the banks tend to be pretty, tight on when these changes come about, sort of forcing them on to everybody. So I'm wondering what you're seeing.
Yeah, I think that's certainly happening, and banks, some have been more proactive than others in reaching out and educating their clients about the impacts and really getting them familiar with the subject so that they need to reach out. There's a limit as to how much the banks can do, though, because of this, the way that the relationship changes. So with a lot of the previous regulatory changes. So for instance, the variation margin rules that came in 2017, the banks were all over that, and they were reaching out to their counterparties, to the funds, to make sure that they were getting set up and to be compliant. That was a lot easier because it didn't require the putting in place of a custodian account. It was really the variation margin rules. Everything was able to be done bilaterally between the banks and the buy side. So that is not the case here. If you don't have a custodian, you need to onboard with a new custodian. That can take many months. So to answer your question, I think the banks are being somewhat proactive. The fact that things have been delayed by a year has, a lot of people have taken the foot off the gas and have not been looking at this over the last few months. It was becoming a pretty hot topic pre-COVID, in February and early March. But with the extension that's been granted, I think a number of funds have and even banks are maybe slowing down in terms of their implementation. I think that for those who think they may be impacted, it's wise to look at this and to start moving forward quickly, so as to not be caught at the end. I think that when this type of change, because it's so involved, if you try and wait to the last minute or wait till the banks are really pushing you, you may find that you're going to be in a tough situation, because the banks might not have capacity, but importantly, the custodians might not have capacity. So setting up a relationship with a new custodian when they don't have capacity, it could be quite tricky.
Right. Yeah, I feel like the tri-parties became popular back in 08, 09 to begin with, when everybody got all worried about collateral and holding of collateral and everything. So, there's probably a good portion of people that are already sort of using that and have less documentation to maybe update, but it's definitely a big deal. I agree. A couple of questions came in here. Let me see if I can make some sense. So the first one is, what happens to UMR if only one party to an ISDA is in scope? I'm not sure I follow that, but I thought I'd read it out for you.
Well, I think I understand the question. If only one party is in scope, so the banks, the swap dealers are pretty much wholesale in scope. So then the question is, are you as a fund, are you in scope? Yes, both parties, so fund and bank, need to be in scope, but we're really concerned at looking at whether or not the fund is in scope, since the banks are already subject to this. So that the relationships between banks and phases 1 to 4 have been done. So those participants in phases 1 to 4, both parties were subject to it, and now we're going to smaller and smaller users of derivatives with these thresholds in the subsequent phases.
Understood. Okay, let's see. We got another question, and this was the same one actually that I had, so I feel better that someone else had this as well. What's going on? I'm not the only one, I guess. What's going on with sort of the LIBOR fallback issues and LIBOR going away, and how have they changed, if they've done it at all yet, on existing documents like the 92s or even the 02s, as far as their definitions? So there's a fallback to deal with once, potentially the LIBOR goes away.
Yeah. So the ISDA has been the ISDA Association has been quite to the forefront of this in terms of publishing fallbacks that are available. I believe those fallbacks are already available to participants to include. I'm not sure exactly where we are in the implementation of this, but there will, and whether or not a protocol is available now or if it will be soon. I haven't seen, from my side, I haven't seen that much change happening yet in terms of managers moving to use these new the new benchmarks or changing documentation. I think going forward, people will want to start using the new benchmarks. Hopefully, and I think from a documentation perspective, I think that it will be relatively light in terms of how this will impact the actual legal documents because of the protocols that will be implemented. There's certainly quite a few considerations around, how does the new benchmark compare to the outgoing LIBOR one, and how does that impact the economics of the transaction? So certainly something that that managers are looking at, and I think should continue to be looking at, so that they're prepared for those changes as and when they come.
Got it. Okay, that's good to know, actually. Let's see. Banks is the size requirement of the relationship. Is the AUM of the fund, or is there a minimum size of trade required? And does that impact the ISDA terms? But I think they're just simply asking about the size of the fund and the relationship there.
Yeah, so size of fund is a factor. I've heard the number floated around 25 million as a minimum AUM. There are some a number of banks that with an entity that's smaller than 25 million, they're not able to get approval, and they won't consider it. So there is a minimum size requirement. for some. You can, there's also, so that, and the size will affect the quality of the terms, as will the significance of the business relationship. So if, as with any other trading agreement, but if the business relationship stands to be quite lucrative for the bank, they're going to be much more open to negotiation of legal terms, and the business and sales folks at the banks will be pushing document negotiators, and also may help working through issues with credit. Credit is really an independent function at the banks. They will assess the riskiness of the portfolio and the trading that's intended to be underdone. So there's a limit as to how much the importance of the business and the economics will be able to move the credit folks, depending on how they view the fund. But certainly smaller funds don't get the same terms that big funds get. There is a difference, and as you get to the larger and the really large funds, they're able to command much better terms. That said, I think a number of the things that we discussed, I think are attainable even for smaller funds, and they're things that smaller funds should be asking for.
Understood. A practical question on something you touched on earlier, under the category of Fisher cut bait or NAV triggers and notifications, etc. So assuming you don't have any language covering it, assuming you trigger a NAV trigger, and a lot of these banks I've always found to be a bit disjointed and, maybe understaffed or not following some of this as closely as they could. So once you notify them, hey, I have a 15% trigger for a month, we're 20% down for the month, here's our notification to it. A lot of times, believe it or not, when things are going really bad and there's thousands of funds not doing well, you might not hear anything from them. So assuming you don't have the language that gives them a certain amount of time to respond, what do you typically do in that type of situation to deal with it? Do you give them some type of negative confirmation request if we don't hear from you in a certain time? How do you recommend dealing with that?
So yeah, that can certainly happen. I recommend that what you suggested about kind of a negative affirmation request, I don't think that would be effective, because the ISDA has a specific language around waivers, that no waivers are granted unless agreed in writing. So I don't think that would be of any effect. I think what you do in that case, well, first of all, if you see a NAV decline coming, if you think you're going to be subject to something, get out ahead of it. Don't wait until month end. Don't wait until your monthly NAV report has been issued, 10 and 15, 20 days after month end. Have the discussion as soon as possible with the counterparty. Try and get to them before everyone else has rushed in. That's one. The other thing is help them help you, meaning if you want a waiver, if you want an amendment to an agreement, I suggest you draft that document yourself. You be proactive. You don't just go to them and say, hey, we've hit this, can you please waive, send us a waiver, because that means that they need to go back and they need to get documentation people working. If you're more proactive and you say, we've hit this, we've drafted this waiver for you, please sign at the bottom, it's easier to get it through to their legal and to get things approved. So that's, those are two tips I would give in that situation.
And what happens when they just never respond?
If they never respond, I think your rights are limited. I think if they're not responding to you at all, maybe it's some cause for concern. I would say it's probably cause for concern, and you may want to limit trading with them going forward, or move trades, or I don't know. If you're not getting any response at all, then that's pretty significant. If your salespeople are not able to get any traction, that's actually a good point. The relationship aspect is one. The legal terms are important, but the relationship aspect is just as important, and in some cases more important. You need to make sure that you're keeping good relationship with your swap dealers and your PBs at all times. You want to be a good client to them. You want to make things easy for them. So I think if managers that approach that and approach things as a partnership throughout the life of their their relationship are going to be better off than the ones that that don't treat their counterparties well,
Yeah.
when things are not going well for them.
Yeah, no, that's a good point. Relationships matter for sure, especially when it comes to this topic. All right, well, that's excellent. You know what? We're right on schedule, so that worked out really nice. I think that was super thorough. We got some good questions in. So what I will do is I'm recording this for everybody, so I will distribute this back out to everybody, including everybody who was registered and not in attendance. And I will, excuse me, share your contacts on there and everything. So if people want, they can reach out directly. And this was great. I hope we can do a third one in a couple of months and go on to a new topic. It was great. I appreciate the time.
Great. No, my pleasure. Thanks very much, Joe. And thanks for everyone for attending.
Right. Terrific. Talk to you soon. Thank you, everybody.
Thanks.